Right. Hello again. It's the third week, and today we're going to talk about types of financial analysis. As usual, why did I choose this topic specifically? Well, I think that the fact that there are so many different ways and approaches into financial analysis, it's both fascinating but also very confusing because, like, to be honest here, I had to go through 1 year of bachelor, focus on finance and investing and everything, and I didn't know much about investing strategies, financial analysis, how do you even assess companies' performance or stocks or assets, better say performance, until the couple of months back. So I thought that just given at least the very brief idea of types of financial analysis would be quite useful. Uh, Although, of course, we can go deeper and discuss every separate type, but this video is like a small overview into three main forms or ways how we can view how we can build our portfolio, I would say. So I will focus on three main types, main in my opinion, and the first is fundamentals analysis. So basically, this is when we look into companies' financial statements. So it can be 10K forms, so annual reports, it can be proxy statements, it can be MD&A, so management discussion and analysis. There are so many statements that company is obliged to submit to trade their stocks, and the amount of information we can get out of it is enormous. Once you really do understand what you're reading in the note 39, at that point you can say that now you are the actual financial analyst. But basically 10K, it's the form of year-to-date data. Generally, what we are looking for there is are the four key financial statements. So balance sheet, income statement, statement of cash flows, and statement of shareholders' equity. We can see many different things besides that, but of course the notes are very important, or the strategy. Everything that is in this statement can be used to a certain extent, but some more, let's say, fundamentals things that we're looking for here are these statements, because we will check the real financial numbers in three possible ways. First is horizontal analysis, where we would compare horizontally from 1 year to another, let's say revenues or capital expenditures, or I don't know, whatever we want to see, by comparing those lines. And we would need several consequent years to see what is the trend, are there any extraordinary changes from, let's say, 2024 to 2025, where we see that, I don't know, the allowance for bad debt increased significantly in 2024, but in 2023 and 2025 it's normal. Then we can kind of see that something was going on there, and we would go to notes to really see what's the issue there, because it's a big red flag when you see those not normal lines. Then the second way is vertical analysis. It's kind of the same as horizontal, but instead of looking like that, you would check the statements from the top to the bottom. The easiest example would be to go with income statement, because you would see the revenue, then cost of goods sold. We were talking about the manufacturing companies. You would see the operating income, all the lines, and you can see where most of the money goes to, or where the investments are made, and you kind of can estimate whether the company is efficient, and what are some blocking points for it to perform better, for instance. Then, of course, MD&A is very important, as we can actually see who, like, what is the strategy of the company, what is their product, how are they different from other companies, why we actually should invest in them. Also, we would see some M&A disclosures or any other disclosures that are applicable for investors to like make more informed decisions. We can quite likely find in MD&A. Then proxy would be used. I really hope that I'm not mixing them up now. But proxy would be used if we want to see who is sitting in the board of directors, for instance. And what we would check is if the CEO's, accidentally, if the CEO's brother is also sitting in the BOD. And yeah, we don't really want to have this kind of situation because it will be like the decisions made by the company or by the BOD would be kind of biased, and it's not a very good thing to see these connections. Then, of course, the last way to look into fundamentals is KPIs or metrics or ratios, which, for instance, ROE, so return on equity, or ROA, so return on asset, price to equity, or price to book, or debt to equity, like asset turnover. There are, I guess, dozens of these if you really want to look into that, and every industry would have a bit different kind of approach into assessing or accessing the same metrics. And these basically, well, of course, they're meaningless unless we have an industry average, for instance, to compare them with, or we don't, or if we don't have like the KPIs or metrics or ratios for like several years from the company to see the trend. Unless we have these standpoints to compare, they're meaningless. But still, we can see how healthy the company is in general. Of course, we also see how profitable it is or how quickly, I don't know, it sells, its inventories, everything, but also with some of the ratios, for instance, as price to earnings or price to book, we can see how also public values the company. For instance, if the price to book value is too high, we can see that perhaps investors are overvaluing the company because, well, the market price of the share is way above the book price, if we would simplify that. So, generally speaking, there are like hundreds of ways to analyze the financial statements of the company and the metrics, but the key objective of the fundamentals analysis is to estimate the company's health, overall health, and value for an investment. The second type is sentiment analysis. So, in short, with sentiment analysis, we want to see how general public perceives the company. It is not necessarily about the profitability of the company or whether it is a good or not investment. It's more about what are the words that are appearing in news headlines or whatever, social media posts together with the name of the company. So what we're looking for here is, let's say, whether the news headlines are Goldman Sachs is the best company ever or Goldman Sachs ruins our world. So these are kind of the sentiment that we're trying to assess and access, because the first statement would imply positive sentiment and the second would imply quite a negative one. And we want to just see like what is the public appearance of the company, what people are saying about it, not just investors, not, I don't know, employees of the company, but all dimensions. And there are several ways to perform the sentiment analysis. I would say a classic one, or like the easiest one perhaps, would be to just read tons of social media, of news, of everything, and to kind of analyze, like put it through yourself and see what is like the general image that we are seeing here. Or another approach, and I think that is what more professional analysts are also using, is via programming in either Excel or let's say Python or other programming language. So basically we would, let's say, download a special model, install it into our Python, and we would assess the sentiment of, I don't know, what I did, for instance, of the several headlines, of not just several, but numerous headlines, and we would just see of what is the overall sentiment, or what is the sentiment of like the special words that we are trying to indicate and analyze. And then lastly, there is technical analysis, if I only knew how to spell that and how to write it, apparently. So this is all the, if you would, I don't know, type trading in Pinterest or internet or like Google, whatever, you would see like all those funny price charts. And this is exactly what technical analysis is about. So analysts or traders are assessing the price charts of a certain asset or security. So they're trying to see some market trends and price movements and make basically stakes on those movements. So they are heavily adopting the supply and demand framework in their analysis, and also of course they would draw like many nice triangles or lines. There are many formulas, many frameworks and studies of how you can identify those trends and make like the best exit and enter and exit strategy. But the end goal is just to see the trend, buy at the right time and sell at the right time. And well, what is the conclusion? How all these techniques can be combined all together to make good investment decisions? Well, I mean, it's better to ask like like proper professional in that field. But in my opinion, only via the combination of all three you kind of can freely invest. What I mean by that is, for instance, you perform the fundamental analysis. You like spend a good like week reading the financial statement, and you're like, yeah, no, you know what? The company is undervalued. Now the stocks must be like very at a low price, but I don't know. The assets are actually worth more, and or I think that the earnings will increase soon enough, or in 10 years, whatever, and you want to buy some stocks, but of course you do not want to buy them like at the higher price. You would prefer to buy more at the lower price, so that after, I don't know, 10 years you can say a higher number of stocks. So that is where the technical analysis comes in. You would see the graphs, you would see like some trends going on, and you would maybe estimate a little bit. Maybe you need to wait for a couple of days and place your order when the price is lower, and yeah, and then you can buy more, obviously, and this is how they're combined. Or for instance, I don't know, you're just following the technical approach. You're checking all your graphs, all the triangles, and suddenly everything aligns. And you're like, you know, like this is this triangle happening. I don't know, the MACD is right, and I should buy it here. It's going to go up after like, I don't know, an hour. But then suddenly it goes down. Of course, we can say that, oh, maybe the framework that you had wasn't as good, but in the end, it was that, I don't know, the CEO of the company that which stocks you bought suddenly appeared in the Epstein files, and now, no matter what is the actual valuation of the company, we would go back to the fundamentals analysis, or what were your predictions, and perhaps your predictions would have been right, but the sentiment analysis is not as good. Like, for instance, the public already heard some rumors, gosh, about the CEO and everything, and the sentiment wasn't as good already, and kind of, even though it was reflected, maybe some very sudden news came out, and we ended up in this situation that the price just decreased and you lost all your money. So in my opinion, in the end, if somehow all the frameworks can be combined all together and used to make the decisions, it might be just the best approach to get the most informed decisions. So thank you, and I see you next week.